Are you wondering how interest rates impact your daily life? Look no further than the federal funds rate, or FFR, which is one of the most important interest rates in the world. In this video, we'll explore what the federal funds rate is and how it impacts the economy, consumer interest rates, investments, the US dollar, and international markets. Federal funds rate basics. The federal funds rate is the average interest rate that banks pay for overnight borrowing in the federal funds market, and it's determined by the Federal Reserve. The Fed sets a target range for the federal funds rate with a lower and upper bound, and in 2022, the target rates range from 0% to 4.5%. Impact on consumer interest rates. The federal funds rate indirectly influences many other interest rates, such as the prime rate, which affects consumer interest rates on credit cards, bank loans, and adjustable rate mortgages. In fact, the federal funds rate can indirectly influence even longer-term interest rates, such as those on treasury notes and conventional mortgages. Fed tools and economic management. The Federal Open Market Committee, FOMC, uses two tools to keep the federal funds rate in the target rate range: interest on reserve balances, IORB, and overnight reverse repurchases, ON-RRP. The committee sets the IORB and ON-RRP rates to manage the effective federal funds rate, which then influences business and consumer spending. Influencing the federal funds rate helps the Fed manage inflation, promote maximum employment, and keep interest rates moderate. The FOMC members monitor the core inflation rate for long-term signs of inflation and adjust the rates accordingly. Impact on investments. The federal funds rate can have a significant impact on the stock market. When the federal funds rate goes up, stocks may go down, and when the federal funds rate decreases, stocks may go up. However, the relationship between the federal funds rate and the stock market isn't always straightforward, and geopolitical tensions or company-specific news can influence stock prices. Impact on the US dollar. The federal funds rate also impacts the value of the US dollar. When the federal funds rate goes up, the dollar tends to strengthen against other currencies, and when the federal funds rate goes down, the dollar tends to weaken. Higher interest rates attract foreign investors looking for a better return on their investments, driving up the demand for dollars and its value. Impact on international markets. The federal funds rate can also have a ripple effect on other economies around the world, as many countries tie their currencies to the US dollar. Changes in the federal funds rate can cause other countries to adjust their own rates to maintain the currency peg, and changes in the dollar's value can impact global trade and inflation. In conclusion, the federal funds rate is the most powerful interest rate in the world. The Federal Reserve uses various tools to adjust the FFR, which influences many other interest rates, including those on credit cards, mortgages, and bank loans. It also affects the value of the US dollar and other household and business assets. The FOMC sets a target range for the FFR, which it manages using interest on reserve balances and overnight reverse repurchases. The Fed uses the FFR to manage inflation, promote maximum employment, and keep interest rates moderate. Changes in the FFR can have a significant impact on the economy, the stock market, the value of the US dollar, and international markets. Understanding how the FFR works and its impact on various financial and economic indicators is essential for investors and consumers alike. If you're looking to stay informed about changes in the FFR and the Federal Reserve's monetary policy, be sure to keep an eye on the monthly FOMC meetings and statements.